All right, let's get started. Thank you everybody for joining me once again for another monthly webinar. This time the topic is how to manage your ESPP. A lot of interest in this topic this time around, so I really appreciate you taking the time to join. Um, I've got 20 minutes of content here, and then I'll do questions after that. You can put your questions in the chat or the Q&A, whichever you're more comfortable with. And I plan to stay on as long as it takes to get through all the questions. So you can do that anytime. So first off, who am I? My name is Joe Morgan. I'm a CFA and a CFP. I've spent my entire career in the financial industry, 25 years managing money for large institutions, endowment funds, and technology companies. I was chief investment officer at Silicon Valley Bank, so we banked a lot of technology companies. But the last 6 years, I've been working with families, primarily in the Bay Area, on their personal finances, and in particular, people who have stock awards who are ready to integrate those into their financial lives. That's really typically my focus initially with clients. Then we build a financial plan and go forward. This is not today financial advice. Financial advice should be specific to you and your situation. I don't know you. I don't know your situation. Even in the Q&A, I don't know the full story. So just take this for what it is. I have a lot of webinars out there. Happy to share them. Just reach out to me and I'll give you the link. So first off, we talk about all of these financial topics in the area of financial planning. We want to build a financial life that's right for us. I call it your best financial life. And there's 4 areas here, as you can see: protect what you have, know where it goes, make it grow, retain independence and dignity. If we do all 4 of those right with intention and purposeful effort, we'll build the best financial life that we can have. It may not be the best financial life on our block. There may be somebody else who's more fortunate than us, but we're going to do the best we can with the resources we have and what we want to accomplish. This is the process I go through with clients. I only put this up here because I want to point out that we're talking about ESPP today, and you see how far down that takes place in the process. So we should already know what our goals are. We should already know what our spending is, all that stuff. This is a tiny part of your financial life, and it's important to do it right. But I just want to illustrate how small this area really is. We got to get everything aligned in our financial life to make this all work. So let's dive right in now. Today, we're going to talk about ESPPs. What is an ESPP? Why should we have a process to sell our ESPPs? And we want to talk about a tax smart way to do that. So we got a lot to get to today. So what is an ESPP? So ESPP stands for Employee Stock Purchase Plan. So this is a plan that your employer has that gives you the right to buy stock in your company using funds that are deducted from your paycheck each week. Now, the way it works is there's an offering period. That's when they're deducting the money out of your paycheck. That money just sits off to the side somewhere. And then there's the purchase date when the stock is actually purchased. Now, why would anybody do this? Well, you do it because you can buy the stock without paying commission, but you can also buy the stock typically with a discount. And the typical plan out there is structured with a 15% discount. And typically it also has a look back period, which means it's not just 15% off the price on the day that you buy it, it's the lower of that price or the day at the beginning when they started taking money out of your paycheck. So if your stock's going up, it could be a real value. So let's go through a couple examples just to illustrate how this works. First off, let's take the scenario where your stock price rises. So, okay, so you enroll in the program when the stock is $100. They start taking money out of your paycheck. Remember, you don't have any stock yet. They're just taking money out of your paycheck and setting it aside. We get to the end of the 6-month period, and the stock is now 120 because the stock has gone up. So if your plan has a look back feature, you get to buy this stock at 15% discount to the $100, the original price, the lower of 100 or 120. So you get to buy the stock for $85 and it's worth today $120. So you buy it today, it's worth $120. That's $35 of free money, and we like free money. So this is why ESPP programs are so popular with employees, and why, if you can, you should max out your contribution, because you're getting free money by contributing. Now, you might say, well, what if the stock price goes down? Well, let's talk about that real quick there at the bottom of the page. So now we enroll, stock price is $100. 6 months goes by, they're taking money out of our checks. Stock price is now $80. Okay, well, we get to buy the stock at 15% discount of the lower of 100 or 80. So it's 15% off 80. We pay $68 now for something that's worth $80. We can immediately sell it and have a $12 gain. We still get free money, just a little less, but we still get free money. So we like free money. And so that's why ESPP is very popular. Now, taxes are fairly complicated for ESPP. So I'm going to talk about how the taxes work here. And then I'm going to talk about strategies. And you'll see when we get to strategies that it's not so important how the taxes work, I think, if you do this a particular way. So anyways, here we go with the taxes. So capital gains treatment depends on 2 holding period requirements. So you have to hold it 2 years from the start of the offering period. That's the period where they start taking money out of your paycheck. So 2 years from that date, and 1 year from the date it was purchased. So in effect, this means that you typically have to hold it for 1 to 1.5 years in order to get the capital gains treatment, as opposed to the income tax treatment. Now I'm going to talk about a little bit about the numbers, about what that means here in a moment. But there's also some additional wrinkles. So if you sell before that period, then the discount versus the offering price when you buy it is ordinary income. And then any additional gain is capital gains. If you sell it after that period, in other words, if you hold it for that year and a half, then you still pay some ordinary income rates. Remember, that's the bad rates. That's the rates we don't want to pay. But you have to pay some. It's just that it's the difference. It's that 15% difference between what you paid and the price at the beginning of the period. So not the end of the period, the beginning of the period. And then the rest is taxed at long-term capital gains, and that's the good stuff. So that's basically how it works. Let me just talk a little bit about strategies, again, thinking about the tax. So let's say we sell it immediately. So we get that free money, $12 or $25 or $45, whatever it is per share, and we sell it on the day we get the stock. Well, in that case, the entire discount, the entire amount of free money is taxed as ordinary income, as if that's a paycheck for you, basically. So what are those rates? They're 24 to 37%. So that's what people talk about, what tax bracket they're in. That's what they're talking about, is the federal tax bracket, 24 to 37%, depending on your income. That's probably about right. Now, in order to get better tax treatment, you have to hold the stock for 1 to 1.5 years, as I mentioned. If the stock goes up, then the discount based on the offering price is taxed at ordinary income. We know that. Any further gain is taxed at long-term capital gains. So long-term capital gains is 15 to 23.8%. Now, a lot of people think, well, no, it's 15 or 20. Yeah, but if you make over a certain dollar amount, which I believe is $200,000 for a couple, there's an extra 3.8% Medicare tax. So that's why it's not really 20, it's 23.8. So the difference, the tax advantage you're talking about is going from 15 to 23.8 up to 24 to 37. So the total difference is somewhere between 9 and 13%. That's how much tax savings you would be trying to get by holding on to your ESPP shares for that year to year and a half period. Now, let me ask you a question. Your stock vests, I'm sorry, you buy the stock, the ESPP, you're sitting there staring down a year holding period to get long-term capital gains treatment, to get better tax treatment of about 9 to 13%. What are the chances that your stock in that year actually goes down by 9 to 13%? And I ask that question because if it goes down by that amount, then you've totally lost the tax advantage that you were holding on for. So that to me does not seem like a very big move. I mean, I don't know what company you work for, but my guess is, stocks are pretty volatile on an individual basis. And so if you think about what happened last year during COVID or any period, There's always downdrafts. So you could find yourself holding on to that stock, keeping your capital tied up for that period, and still not getting the tax advantage that you want. You'll get taxed at a lower rate, but if the stock price has gone down further than that, you'll end up with less money. So this is kind of a bird in the hand, two in the bush scenario, and I think there's significant risk to trying to hold on to the stock. But we're all in different situations. Depends on how much stock you have. Depends on. It does not depend on your outlook for your company, because let me tell you, none of us know what the stock price for our company is going to do over the next year. Although sometimes we may feel that way, we don't. But it does depend on how much stock you have, what your risk level is. So let's talk about that for a second. I like to think about the risk that we have in our company stock as a percentage of our total assets, what we have, what we completely own. That's a good starting point. So here's an example. Here's somebody that has company stock that's about 20% of their total assets. They've got savings, which is, checking account, savings accounts of about 10%. They've got 30% in their 401k retirement plans, and they've got 40% in their house, the value of their house. So 20% of their total assets is in their company stock. So the question is, are you comfortable owning 20% of your total assets in common stock? And there's no right or wrong answer, really isn't. But I would say, you know what, that's a good first look, but let's look a little closer. What we're talking about is these are all assets that we're planning on using we're talking about assets that we're planning on using to pay for things, to do the things we want in life. Now, I would argue your house is probably not one of those things. You're not going to sell your house in order to go do something, right? It's not a funding mechanism for your financial life. Or it could be, I should say. Sometimes we get into a position where we're forced to have it be. We have to take out a mortgage on the house just to stay in it to pay our bills. Definitely see that quite a bit. But we really don't want to rely on the home equity for our future expenses. So if we take that out and say, okay, if we take that out, then what we're left with is really financial assets, right? The 401k, savings, and the company stock. So same person, same situation. Let's take out the house. Now we've got company stock is 33% of our financial assets. Oh, geez, gave the answer there. 33% of our financial assets, 17% is savings, and 50% is our 401k. So now the question is, are you comfortable having 33%, a third of your financial assets in company stock? And I would again say, well, wait just a second. If you're under 59 and a half years old, you can't really take this money out of your 401k without paying a penalty, 10% penalty. We don't want to pay penalty for living our normal lifestyle. So I would say you actually have to take that out of the equation too when you're looking at how diversified you are and where your exposure is. So if we take that out, now we've got 67% of our liquid assets in company stock and 33% in our savings, checking accounts, savings accounts, that sort of stuff. So now I'd ask the question, are you comfortable with 67% of your liquid assets in your company stock? Now, this is a hypothetical example. That was the same person all the way through. All we did was adjust basically the denominator by saying, okay, what's realistic? Are we realistically going to depend on the value of our house for our living expenses? No. Are we going to realistically depend on the value of our 401k for our living expenses? Well, if you're not 59 and a half, probably not. You shouldn't you don't want to plan on paying those penalties. And so we're left here. So what originally looked like maybe a smaller amount of stock now looks like, our immediate wealth, our future expenses are really well tied to the value of the stock. And not only that, our income comes from the value of the stock too, right? So we're undiversified in a couple of ways. So that's why, as a rule, we should always think about, well, we should do this analysis. And if we're comfortable where we are, then that's fine. I don't really have a problem holding company stock for sure. But it's more likely that we should always have some sort of program in place to be reducing the stock that we have. And so here's basically a top level view of what I call a tax smart way to transition your equity into your financial life, your company stock into your financial life. And there's a lot of detail behind this, but I wanted to give you an idea of the basics, how it works. So here's the deal. Our objective is to reduce our exposure to company stock, right? It's to reduce this 67%. That's really what we're trying to do. Now, we want to be cognizant of the fact that there's a tax cost there, right? When we sell the stock, we've got to pay some taxes. So we got to be cognizant of that. So here's the method. First, lay out every line item of stock you own. And when I say line item, I mean every vesting period. So if you have RSUs, if you have PSUs, if you have options, whatever you've got, lay it out by vesting, okay? And I'm not the future vesting, but what's already vested, lay that out in a spreadsheet and calculate the tax cost if you were to sell it today. Then calculate the percentage that tax cost is of the total amount. So you may have an RSU that vested 5 years ago and the stock's gone way up. And so your capital gains have gone way up. And even though you're paying long-term capital gains now, your actual tax cost may be fairly high, because even though you're multiplying by a lower rate, the gain is so big that the tax cost is high. So we want to show that as a percentage of each lot. Then we want to rank them and sell them in order of the lowest tax cost going to the highest tax cost. So what does that mean? That means we're going to sell the shares that are not going to cause much of a tax burden first. And we're going to do this, if we're doing this over a course of a number of years, we're going to have a budget for each year. How much tax cost do we want to take? So you see there at the bottom, the example I have is there's $30,000 of tax cost. So instead of selling, and we've got $100,000 of stock. So instead of selling an equal amount of stock for 3 years, you could do that, but your tax cost is not going to be the same each year. And I prefer to say, well, what we're concerned about is the tax cost. So let's make the tax cost equal each year. And that'll allow us to sell more stock in year 1 than we do in year 2, and more stock in year 2 than we do in year 3, because we're focusing on the low tax cost lots, and that'll get us there. If you take this example to the extreme and you think about RSUs, when RSUs vest, you're taxed on the date of vesting. And so on that date, your tax cost to sell is 0. It's as if they gave you a paycheck and you turned around and went out and bought the stock that day. There's no additional tax liability. You're already taxed on the RSU that vested. So what do you do with those? We sell those immediately. If you have a program to sell your stock over time, vesting RSUs should be sold immediately, and they don't even enter into this plan because they don't have a tax cost. You're just shifting that exposure out because you're trying to get that pie slice a little bit smaller. And all of these funds are going into your long-term investment portfolio. We have another webinar that talks about constructing that, but that's where they go. We've got a place for them to go. Every dollar has a job. All right. So that's my presentation today on ESPP. My question would be, what about you? Where are you on your ESPP? So you're going to get an email because you registered for this. You're going to get an email with a link to the replay and also these slides. And I ask you to download the slides, review what we talked about today, because 20-minute webinar is pretty quick. Consider whether you're looking at your company stock the right way. And if you have a selling program, consider whether you're doing it the best way. And if you have questions about that, schedule a call with me. I offer coaching sessions, and the first coaching session is always free. So if we haven't had a coaching session before, we could have a free 45-minute session. We'll look at it together. I promise no sales pitch, no cost. That's what I mean by free. In terms of resources, I'm out there. I've got my website. I've got a podcast called Deliberate Money Moves. My blog, we're coming out with some video tutorials pretty soon. Really excited about that. Facebook page, YouTube channel, all this stuff. Next month on May 6th, our topic is going to be how to manage your RSUs. And we did this one last year in July or August. It was super popular. So there'll be a registration link for this when we send out the email following up, with these slides. You'll be able to register for next month's if you want. And again, you don't have to attend. You'll get the replay link if you just register. So That's all I had for today. Happy to take any questions or go over any part of this again. If anybody has any questions, you could just put them in the Q&A or in the chat. And right now, you can tell I'm stalling a little bit. There are no questions, but I want to give folks some time if you do have a question to throw it in there. So we'll just hang out for a minute or two, and if nobody has a question, we'll call it a day. Good attendance today, by the way. Again, thank you so much for taking time to join us live. Asking questions is the biggest benefit of joining live. You can always watch the replay later as well. Let's see, still no questions. There's still several people listening though. A lot of people sitting there going, should I ask a question? Should I not ask a question? Come on, ask a question. All right, here we go. A friend has more than 2/3 of assets in company stock. Why is that bad? Well, good question. I'm not saying it's necessarily bad. It may work out fantastic, right? That's really how really rich people get rich, is by being undiversified and making a big bet on something, right? Mark Zuckerberg did not get rich by diversifying his stock at every chance he could, right? He got rich by making Facebook what it is and keeping as much of the company as he possibly could. So I'm not saying it's bad to own a lot of company stock. Here's what I'm saying. It's risky to own a lot of company stock. So you have to look at what your priorities are, what risk you're willing to take, and how you're willing to get there. So that's why even going through those pie charts, even at 66%, maybe that's not so bad. Maybe that's really what you want. If you're okay with that 66% possibly going to zero, then maybe that's okay. And I don't know what company you work for, but I know companies go out of business every day, even big companies. And they make mistakes. Even if they don't go out of business, they make mistakes and the stocks drop. Look at some of even the tech stocks out there after IPO, how they've dropped. It caused some big tax burdens for employees at companies like Lyft and other companies that are good companies. So there's risk there. So the question is not, is it good or bad? We certainly can't predict where things are going to go. The question is, how much risk do you want to take in your financial life? And that's part of the equation that often gets left out of the discussion. And that's why I like to bring it up. So that's my answer. If you have a follow-up question or disagreement, please go ahead and throw it in the chat. And anybody else with a question? We still have several people online, so give it another minute here. I should say, I think I had it here. Yeah, if you want to have that conversation with me, the free conversation, it's joe@bestfinlife.com. You can also just reply to the email that's going to get sent out as well. So I don't think there's any more questions. Thank you so much for your time. I really appreciate your attention.